Welcome, everyone. Thank you for joining us today. I'm 𝗖𝗽 Biniaz. I'm joined by 𝗖𝗽 Benesocky. Welcome, Ava.
Thank you, August. Hello, everybody. Today we are joined by 𝗖𝗽 𝗖𝗽. Welcome, 𝗖𝗽.
Welcome, 𝗖𝗽.
Hey, thanks for having me, everybody.
Awesome.
Wonderful. Why don't we start off, 𝗖𝗽, by you telling us about yourself and your background, please.
Okay. Well, how far do you want to go back? Back to the dawn of time, or?
Sure.
So I'm a practicing lawyer. I'm a full-time real estate commercial securities lawyer here in the United States. I'm currently in Dallas, Fort Worth, but we have offices in the greater Los Angeles area as well, Santa Barbara to be exact. But I was born and raised in Montana. And so I have a lot of family that have Canadian roots in the Alberta area. And so what I do on a day-to-day basis basically is help people, whether you're a newbie, a seasoned operator, or a passive investor looking to invest in a current syndication in the commercial real estate market. I handle those transactions for people from acceptance of their LOI to the closing table for operators, for passive investors looking at a deal, what flags or warning signs there are, or giving them advice and consent on whether to invest or not, and on all the related topics that kind of pop up in the life cycle of owning a commercial real estate asset.
Amazing.
That's fantastic.
That's incredible. So usually when people hear about a securities lawyer, they always, a securities corporate lawyer, they always think about that it is for advice given to the sponsor, the general partner. But as you just mentioned, limited partners and investors can also use the services of a lawyer to kind of check over the PPM, the team involved, so to do their due diligence. That's great that you mentioned that.
Yeah,
the vast majority, right? The vast majority of people that invest are actually passive investors. There's just a small section of people that are obviously they're voracious. They have voracious appetites. They're followers of informational content like this. They're operators, but in large part, passive investors make up the largest market of who is actually doing something in the deal. And these are people that are investing their hard-earned money into an opportunity to hopefully grow it.
Absolutely. Well said.
Now, 𝗖𝗽, you're a common face on multi-family investing summits, podcasts, webinars. Tell us about what was it about multifamily real estate that interested you to advise and assist apartment syndicators and passive investors?
Yeah. So when I started practicing law over 20 years ago, I was a litigator. So I went to law school thinking to myself that I was going to tear up the courtroom and do jury trials. And that was what was really appealing to me, right? So for most people that go to law school, or at least me, I saw TV, movies, those sorts of things. And I thought to myself, that's what I wanted to go do. And I shortly found out after practicing law for close to a decade that litigation was the unhappy business. So people that were either having to be sued, or they were being sued, or they were having to do something to set right the system or to fight for justice. The reality was the results just didn't match what they expected. And so even if you won a big verdict, I remember trying a big case, getting a verdict for like $43 million. And the client at the time, that wasn't enough. And then going back and the judge cut the amount, was not happy. So I realized that being in the unhappy business was not necessarily for me. And so I had always been handling the litigation side when deals go bad for clients, developers, syndicators, operators. And I had a good client, a good friend of mine say, you really should start doing the transactional side, because you already have a mindset of what, if things go bad, what should have happened. So why don't you start helping people on the front side? And so I took that as a piece of good advice and wisdom, and I started doing that. And lo and behold, after a few years, I stopped doing litigation almost entirely. And now for the last, 5+ years have been 100% essentially in the transactional commercial real estate securities realm.
Incredible. Incredible. Soldiers are in the trenches and the generals are back in the tent. So you moved your way back there and out of the trenches, out of the litigation realm. So we really appreciate that. So
now,
yeah.
I wanted to jump right into this and let's discuss raising capital. So as apartment syndicators, a major component of the business is raising money, raising capital. But apartment syndicators cannot be in the business of raising capital.
Right.
We're in the business of raising money. If you're in the business of raising money, you need to be licensed.
That's right.
Or you have to have other designations. Now, it seems a bit paradoxical. Can you walk us through the process, Dugan? Because one has to pool together capital, investors' capital, to buy a large asset, but one can't be in the business of raising capital money. So how does that work, and what is the remedy?
Right. So when we're talking about pooling money, really what we're talking about is for anybody that's ever owned their own home. All right. So I've been blessed to have owned a number of homes throughout the 3 years with myself and my wife. And the bank or the title company, whoever's going to close on your house, says, here's the amount of money that you personally need to write a check to, right? Write a check to the bank to get the down payment so you get the loan to get the keys to your house. Well, when we're talking about apartment syndication, what we're really talking about is not just a single house. We're talking about large assets that potentially could be millions, if not tens of millions of dollars. So that down payment exponentially is much larger than what most people have in their own bank account or access to or in their own pocket. And so the process of pooling money is basically what we do is we're going to use other people's money. Those are passive investors, and we're going to provide a decent return for them. But it's that process of pooling their money to get the down payment, to get the keys to the asset, whether it's an apartment building or a commercial strip mall or whatever it is. It's that process. And what the SEC, the Securities and Exchange Commission, at least says in the United States says, hey, if you're going to be in that business for somebody else, right? It's not your deal, it's somebody else's deal. And you're going to be raising capital with an expectation of receiving some sort of compensation, whether it's a part of the acquisition fee or the asset management fee, or even what we call the carried interest or the promote, the back end, if you will. You need to be a registered broker dealer. And the reason behind that is because if you're going to be selling securities, the SEC was created to protect unsuspecting investors from unscrupulous operators who are not telling them all of the truth, meaning all of the truth of the risks associated with investing. And so if you're going to be doing it for somebody else, right? Just like what Ava said, if you're doing it for somebody else, you have to be a registered broker dealer. But if it is your deal, if it's your deal and you're raising private capital for your own deal, then in large part, there are exemptions that allow you to not have to be a registered broker dealer, that you could raise capital because you're selling your own securities for purposes of the acquisition of that particular asset. So it is a distinction there, but it's important to understand that the policy behind why the SEC wants people to be registered is really for the protection of the passive investors, which we should all want. We want to make sure that all of our deals are always open, transparent, honest with the passive investors to make sure that they fully understand what the risks are associated with investing.
Thank you for explaining that. Now, there's two parts I wanted to touch on with what we were just discussing. The first one is people who are in the business of raising money. As you said, they're called broker dealers in the US. Here in Canada, they're called exempt market dealers.
Dealing reps
or
exempt
dealing reps.
market dealers.
So these are people who are licensed to raise money. Now, are there other intermediaries that apartment syndicators could use as a service to raise money?
Yeah, so the vast majority of people in the United States that raise money and it's not their deal, they have to fall into that registration component, or unless they're going to participate in like a crowdfunding platform, right?
Okay. Okay.
Which has its own drawbacks in the States, where we have limits and caps on how much certain offerings can be for those purposes. So I think Canada probably provides a little bit better avenue, some more avenues or opportunities for people that aren't registered to be able to participate. But in the States, it's either it is your deal, you're a co-sponsor on that deal. So if you have multiple general partners, co-sponsors, syndicators, operators, those terms, we're all using them interchangeably. Then it is their deal and they can participate in raising capital, obviously. But in large part, the SEC is very strict about this, very focused in on this for a good reason, to make sure that it really has to be your deal if you're going to be participating in raising capital. Otherwise, you need to be registered.
Got it. And for me to just touch on that for a moment here is I've been on many clubhouse rooms, and there's conversation all over the place when it comes to raising capital in the US. So, and there was a topic where it came, hey, this idea of apartment syndication, or this idea of real estate syndication, where you're bringing together the knowledge and the capital to take down a real estate asset. Now, certain people this is a team, it's a teamwork, and certain people are good at certain things. Some people are good at managing the assets. Some people are good at finding the assets. Some people are good at the underwriting and the modeling. And there's some people that are just good at raising capital, like 𝗖𝗽𝗶 over here. And now, 𝗖𝗽𝗶 can't be in the business of raising capital because she's not registered. But can 𝗖𝗽𝗶 play a part within this team to spearheading the part of raising capital by also being the co-GP or co-sponsor or partner?
Yeah. Sure. So, I mean, the reality is that anyone that is a part of the general partnership, or that it's your deal and you're trying to syndicate it, has to raise capital. Without being able to raise capital, you're never going to get the loan. You're never going to be able to close on the asset. You're never going to be able to provide any returns to any investors. And so I tell all of my clients that are operators, syndicators, general partners, say the reality is that's a role and responsibility for everyone. Now, you may not be naturally gifted like 𝗖𝗽𝗓 is, right, on being able to raise capital, right? Many of us are not. But the truth is that if you are going to participate in a syndication as part of the sponsorship team, then one of the roles and responsibilities for everyone that participates is to raise capital, because without the ability to raise capital and pool money in order to get the loan to close on the transaction, there is no business. I mean, there's no closing of anything. And there's no transfer of ownership, and there's no returns potentially for investors. So yes, you're absolutely right. Anybody that participates needs to have a mindset that I'm going to do my very best to try to raise capital. Now, we all might not be as gifted as 𝗖𝗽𝗓 in that regard, but it's the trying and it's understanding that responsibility that I think is key for everybody.
It's a great question, August.
Thank you.
Thank you for that. Duke. Now, speaking of raising capital, can we discuss the most common exemptions used to raise capital? The main ones I'm familiar with are the 506C, which is for accredited investors, and then there's the 506B, which is for non-accredited investors, but you can't advertise. And I believe there's a cap at the number of people who can join. And the third one is the crowdfunding exemption, which you were just kind of mentioning about.
So if you could just go over these main exemptions and kind of discuss them, and yeah, that'd be great.
Definitely.
Yeah, you're right. So the 506, what most people are syndicating large assets or commercial multifamily deals in the States, we're doing what we call Regulation D of Rule 506 and 506C or 506B. Those are the exemptions that most people are applying for. 506B is what we call the historical rule. That's the rule that basically says that everyone that is a potential investor in your deal is somebody that you know, somebody that you have a pre-existing substantive relationship with. So therefore, you don't need to advertise because the SEC says there's a general prohibition on what we call solicitation. And the SEC says, why should you need to advertise? If all the people that are investing with you, they know their financial wherewithal, their educational background, their experience, the ability to determine that they are in fact a sophisticated investor. If they don't meet the legal definition of what an accredited investor is, then the SEC says you should not have to advertise. In 2013, there was a large statutory act called the Jobs Act that was passed. And that part of that opened up this 506C opportunity. And what Congress and everybody recognized in the states was that one of the main drivers of the US economy is access to private capital and being able to allow more people to invest in opportunities. In with respect to the commercial real estate market, it says we're going to open up and for the first time allow operators, sponsors to publicly advertise a Reg D offering. But here's the catch, like Ava said, if you're going to do advertising, then all of your investors have to be an accredited investor. And so you can't allow kind of the buddies, the friends, family exemption of allowing up to 35 sophisticated investors, which we can do on a 506B offering. On a 506C offering, the SEC says no, because if you're going to advertise, then the potential investors who are viewing your social media, your website, maybe hearing your radio ad or seeing it on TV, need to have the ability to protect themselves more than those that are not an accredited investor. And the SEC, their opinion is that accredited investors are better able to protect themselves from unscrupulous operators or to determine the risks associated with the investment. So they said, if you're going to advertise, you can't allow people that are not accredited into your investment. That's number one. And then the other big definition distinction is on a 506B offering, most of the people that attest to either I'm an accredited investor or I'm a sophisticated investor, and so I should be allowed to invest, is what we call a self-certification. That means that the investor largely is signing a questionnaire most of the time, attesting to either their accreditation or their level of sophistication, warranting the sponsor saying, hey, we'll allow you to invest. We can trust their word. Why? Because the SEC says, theoretically, you know these people, right? And so you know when they're telling you the truth or when they're not. But on a 506C offering, these are potentially stranger investors. So them telling us that they're an accredited investor, the SEC says that's not good enough. So you, as the sponsor operator, need to take additional steps to independently verify the accredited status of those potential investors. And so it's those two distinctions. Those are the main differences between like a 506B offering and a 506C offering. Both are, you can have unlimited, meaning you can raise unlimited amounts. Both you can have unlimited accredited investors. But in the 506B bucket, you can only have 35 sophisticated investors. 506C bucket, no non-accredited investors can play in your offering.
Great distinction and explanation. And in the last couple of years of me all reading many literature and talking to lawyers, this was the best explanation that I got and the difference between the 506B. I always try to remember the 506B, B stands for brother. And that means that the people who are like your brother, you can bring them on. So that's the way I memorized it.
Very cool.
Great.
Maybe he can elaborate on the crowdfunding.
Crowdfunding, and there's some changes coming to the crowdfunding exemption where I'm predicting will have an effect on real estate prices that amount of raised capital will allow to purchase. So I believe assets from $5 to $20 million approximately will be the market will be hotter for them because now you got this ability to raise more. But if you could kind of touch on that, what it is currently and where is it possibly going, and we can kind of discuss the predictions after.
Right. So crowdfunding historically has been very limited in the States, right? So it's had very tight restrictions. Most of my clients and operators, their acquisitions are too large. They're much larger than what would be qualify for raising crowdfunding. In fact, you were often limited to like $1 million in any calendar year. That was the max that you could essentially raise. Well, they opened that recently, right? So they've expanded it slightly. They've increased those caps to, I believe, $5 million. So it's a good alternative if you're thinking to yourself that you might want to use a public platform to essentially get more eyeballs potentially on your offering. And it looks like more, potentially more volume. The challenge, right? The challenge for most operators, sponsors, whether you're doing a 506B, 506C, or even a crowdfunding, is this is still a relationship business from the standpoint of raising capital. People that know you, like you, trust you, those are the people that are going to invest with you. And so it's the conversion rate, at least amongst my clients, and I think this is probably the general consensus, is that the conversion rate from stranger investor to actual investor through the use of crowdfunding or some sort of public medium or mechanism, it has historically not been great. It just hasn't been because of that kind of that pressing the flesh, right? I need to actually know the person, talk to them about the opportunity. But for some newer operators that don't have the Rolodex that seasoned operators have, they might not have enough people to potentially call about their first opportunity. Crowdfunding is a good alternative for them to think about. And there are lots of vendors out there that will provide some of the much needed services that will fill in some of the knowledge gap potentially for operators to be able to essentially have their offering open for somebody to look at, to think about, to invest in. So it's not great for everybody, but it is, like August said, it's a good avenue that I think is growing. And probably in the next decade, 2 decades, it may overcome what we've historically been doing through either 506B or since 2013 with 506C offerings.
Okay, so see, August, there is a contrast that exists in legal and technical terms here in Canada and the US. And that's where August and I are excited to jump in and kind of explain the difference. Because imagine the Canadian passive investor listening to a podcast or watching a YouTube show, and here's the term crowdfunding, and then just follows what the speaker is saying about this term. So they can get themselves into some trouble because the terminology is actually different. And
associates that term with what crowdfunding is here in Canada, which has its own restrictions and regulations to follow. So we're really happy to kind of create this platform to also give the Canadian version of which one of the what these exemptions are. And just to break down the crowdfunding exemption, break it down a bit more. Is there a we can currently is $1,070,000, I believe, is the maximum that could be raised in a year. That amount is looking to be raised to $5 million. Is there a maximum amount each participant, each investor could invest within that?
It's limited to, I want to make sure that I got this correct, but it's limited to a percentage essentially of their overall income. So remember, the SEC really wants to make sure that whoever's investing has the capability, and it's what we call in the States a suitable investment for them. So somebody that only has $20,000 to their name, right? Maybe they might qualify as a potential investor, but if the minimum investment is $10,000, which is $50,000 potentially, which is 50% of their net worth, is this really a suitable investment for them? And most lawyers would say, no, it's not. So remember, we want to be, for the most part, conservative in the amount of investment compared to the overall net worth and liquidity for a potential investor, so that it's not disproportionate, so that they're not investing all of the money that they have. Like if we're going to Vegas, right? Double green, zero, we're all in. The reality is, investing in the commercial real estate market should not be like that. Yes, it is with risks. There are risks. There are no guarantees in anything except for death and taxes. But the reality is, in order to manage some of those risks, what we, as if we're the sponsor, operator, or syndicator, can do is honestly assess whether this is a suitable investment for the potential investor, knowing all of the facts associated with it, knowing what information they're giving to us to provide about their own personal financial wherewithal to figure out if this is something that should happen. If that makes sense.
Great. No, absolutely it does.
Absolutely.
And here at CPI, the decision we've made is every one of our investors, being investors that we've cultivated a relationship with, organic investors that we have, friends and family, any investor we have gets service to our exempt market dealer. So our basically our version of broker dealers. And one of the main jobs of a broker dealer, exempt market dealer, as they're known here in Canada, is to ensure that this is the right investment for the investor. If the investor is saying, hey, I'm looking to invest $50K in August and Ava's deal, but the investor has that $50K, that's the only money they have to their name, and maybe they're borrowing a portion of it, our exempt market dealer token funder is going to say, hey, this is not the right investment for you. So there's a second set of eyes that oversees the process of investing. So you just don't go by what the
an extra layer of protection for the investors.
Exactly. Well said. So
and they're trying to right now we typically are looking at 5% or less of the overall net worth for potential investors that are going to participate. So that would be essentially the cap on any particular investor on what they could invest in any particular offering through that platform.
Through crowdfunding.
That's right.
Yep.
That's right.
So here in Canada, crowdfunding is capped at $1,500. So each investor can invest a maximum of $1,500, and the operator can only raise, I believe, up to $500,000 on any offering that they have. But I'll double check those numbers. So I want to open it up for questions for our Zoom audience. Please type your questions. Please don't turn on your cameras or her mics. Our listeners on Clubhouse can do that. But we have a question here.
Yeah, we have somebody that says, thank you so much, Eva and August, for putting this together. I was struggling with whether I could raise capital for our fund by myself or must use EMDs, so exempt market dealers. I have registered and studying towards becoming an exempt market dealer to reduce any limitations.
Great. Yeah. And just for me to quickly kind of touch on that, and I'm more than happy for Dugan to get in. It seems like our friend here is from Canada. Yeah. So just a couple of quick items with that. To raise capital, Dugan touched on this earlier. It's very similar here in Canada. So if you are an operator, if you are the GP, or if you are the person who's funding the deal, the regulation allows you to raise capital for your deal. Imagine it as if you found a great, a real estate project that you're getting below market. You can go to your friends and family and say, hey, do you want to invest with me? Same kind of way when it comes to the exempt market. You could raise capital, but you have to follow the regulations and the exemptions that exist. You could also use the assistance of an EMD. And then on your second part of your question, you mentioned that you're looking to get your license as an EMD, possibly as a broker dealer. It's going to be pretty difficult to get your license as an EMD. That's like a brokerage house, but you could do it as a broker dealer. But I believe if you have your license as a broker dealer, you can't just raise for one investment. You have to have multiple investments on your shelf. So you can't only have a license to only raise for yourself. But that's what I believe here in Canada. But Dugan, maybe you can touch on that. Is if somebody is licensed, can an operator like us can Ava go get her license and then just to promote that one deal that we got or the deals that we got, and not to give any options to the investors that are coming to her?
Yeah, so registered broker dealers here in the States are allowed to do what we would call transactional based compensation. That means that they're allowed to charge a percentage of what they raise for any particular offering as compensation. So because they're going through a rigorous screening process, they're working underneath a registered broker dealer. If they're affiliated with a registered broker dealer, there's an expectation that they're also belonging to what we call a self-regulatory organization. In the States, the largest one is called FINRA. And what that does is that adds an extra layer of protection for passive investors. Passive investors, it's very easy for them to file complaints or to bring unscrupulous operators or people that are affiliated with registered broker dealers or broker dealers before FINRA. And a FINRA has an expedited, what we call arbitration process to essentially settle claims and disputes. And so it's a different structure here in the States, but it's similar in the respect that, yes, you have the people that are registered broker dealers go through a rigorous process of both education, licensing, and regulation from the standpoint of a government body like FINRA or like the SEC has direct jurisdiction over them and their offerings. That's an important distinction for people.
Can they only raise for their own product? Can an apartment syndicator get their license and only raise for their own product? Or there's certain things, I believe here in Canada, where you have to have a kind of a multiple different offerings for your investors, and only a certain percentage of the investors who are coming to you for advice can invest into the exempt market or can invest into this type of securities. Is there such restrictions in the US?
No, so like if you're a registered broker dealer in the United States and you're in the business of just selling securities from like 3 companies or 2 offerings or 3 offerings or 1 offering, you could certainly do that. Most registered broker dealers, just like anything, they're diversified, right? So the more clients or opportunities that they have to either raise for the operators are essentially their clients. They're providing their resources and mechanisms to raise capital for those particular offerings, and their obligations and rights and responsibilities and the compensation is set forth in a separate agreement that exists between the operator and the registered broker dealer. But in theory, the registered broker dealer could say, hey, I'm just raising capital for my own deal or for my own deals. And they certainly could do that, provided that their fees are disclosed to their passive investors, provided that they're complying with all of the disclosure requirements that we have to in the States with respect to any particular investment. So you're not restricted to having to be a broker dealer only for, you can't do your own, or you can't just do 1 or 2. You have flexibility, a lot of flexibility in that respect.
Got it. And how come we don't see more operators that are licensed? Is it because the licensing process is cumbersome and
That's a great question.
Time consuming?
It's expensive. It's time consuming. Remember, the biggest exemption from having to be a registered broker dealer is you fall into what we call the issuer exemption, or you're an associated person of the issuer, meaning it's my securities. So for most operators, they didn't go through 7 years of law school or graduate school, or they don't want to spend their time and money and resources going and getting that, only to then essentially be focused in on selling their own securities. They don't need that. They don't need to commit that for that purpose. But if you're thinking to yourself, I really am gifted at this, and I may want to do this for other people, for other operators that I know or whatever, then it might be worth it. I think the challenge for most people is because of the regulations and the fact that it's so easy for somebody to complain and to bring somebody into FINRA, that most operators wisely have thought to themselves, that's not for me. I'm not gonna fall into either the broker or the dealer definition, even though those are very broad definitions in the States. I want to be just in the issuer category. And so as a result, I'm going to make sure that this is my deal. So every deal I do is just my deal. It's not somebody else's.
Okay, fantastic. Now the next question is pretty good. August and I have spent a long time getting our corporate structure up and running in the right way to make this next question. So can you walk us through the process of bringing in international money to the US?
Yeah.
Do the international people have to open an LLC in the States and then transfer the funds?
Yeah, it's a great question. I get to ask this a lot at conferences and everything. And I have lots of friends and family, obviously, that don't live in the States. We're not born in the States, but love to invest in the States. And the reality is Uncle Sam says, hey, the United States is open. It's open for investment. As long as you're not, you don't belong to what we call an OFAC sanctioned country, a country in which the State Department of the United States is not currently doing business with. We welcome in foreign investment from individuals or entities that weren't either created here in the United States or individuals that weren't born here in the United States. The challenge for many operators when they do that is that Uncle Sam says, hey, because they live or their entity is formed in a different country and it's not here, we need to make sure that an appropriate amount of what we call withholding or taxes are actually paid because the property is here in the United States. And remember the two certainties in life, death and taxes? Well, this one focuses on taxes. And so Uncle Sam always gets paid. So the reality is if you're going to allow foreign investment, either from individuals or entities, then the company's CPA will often do a withholding of distributions that are going to flow out to the investor. Typically that withholding amount is around 15%. And that's the main difference between if you're a US based entity or a US born investor that are investing, we don't have to withhold that. We're making those distributions and we're trusting that you are paying your taxes. But if you're not from here, then the reality is Uncle Sam says, I don't really have jurisdiction or want to go over to Canada or the UK or Israel or China or wherever the investor might live at that particular moment and track them down and make them, they'll say, I'm going to force you as the operator to fulfill that obligation and to make those withholdings. So you'll see some operators, as a result, will tell investors who are not born in this country or have entities that were formed in this country that you should form a limited liability company and invest through your limited liability company into the opportunity. And what that does is every entity from its birth here in the United States, if it's a US based entity, that is recognized as a separate and distinct person for taxation purposes. So even though an entity is not a living, breathing human being, Uncle Sam and the IRS says for taxation purposes, it is treated as a living, breathing human being. So as a result, we don't have to make those necessarily withholdings. We will trust that you will do that as the foreign-born investor in the commercial opportunity. So those are some business decisions that have to be made, obviously by the sponsor or the operator, as to what they're willing to do. But it is an interesting issue, certainly as it relates to people that want to invest, whether they're okay with the withholding or whether they want to try to avoid that.
Great point. And just to take the go back a bit here, in 2008, when the financial meltdown was happening in the US dollar was almost at par with the Canadian dollar. At a point it was at par. Many Canadians started buying real estate in the US and they used an LLC to in many cases they used an LLC to be able to buy that real estate. Now, if there was a cash flow or when that real estate asset was eventually sold and they were looking to bring the money back to Canada, the Canadian government, and they had paid their U.S. taxes and they filed for U.S. taxes, but the Canadian government looked at that surplus, that income they'd made, the capital gains they've made from the sale of property as dividends from the company. So when those funds, they paid their taxes in the U.S., and when the funds came to this side, they also were taxed. They were double taxed. So that's an issue that exists. So many operators in the U.S., they're more than happy to accept foreign investment as long as it's being invested through an LLC that makes it all compliant and okay. But the issue with international investors is that when those funds eventually, now if you're planning to keep your money in the US forever, if you're planning to move to the US or immigrate to the US, that's totally fine. But if you have plans of that money ever coming back to Canada, the structure that needs to be created needs to be much more complex than just a LLC. There needs to be limited partnerships and flow through companies and what have you. And for an individual as a passive investors looking to be a passive investor in these apartment syndication or real estate syndications might not make financial sense because you're filing for your U.S. taxes every year. You're paying a fee for those filings, and also you got to do your filings for on your Canadian side, and the creation of all these limited partnerships and corporations might not make sense. And that's the pain point that our company solves is we not only we have our own internal deals, we also partner with active operators in the US who might not be very good at raising capital. So we come on board as the lead syndicator, bringing the majority of the capital needed, and also relieve the pain point for our investors to invest into these investment vehicles and be relieved from double taxation dollar for dollar after filing and paying their U.S. taxes on the income. So I hope that was helpful for you.
I always tell people, through a web of corporations and limited partnerships, we are able to relieve our fellow Canadians from double taxation, and they still get to reap the benefits of investing into these alternative investments that are in the U.S. because the numbers here in Canada don't make sense. You won't be receiving the same. You just can't get the same opportunity here in Canada.
Unfortunately, the real estate fundamentals of appreciation and cash flow at the same time don't exist here in Canada. If there is cash flow, there is no appreciation. If there is appreciation, there is no cash flow. Kind of similar to California and New York kind of idea, where the cap rates are so compressed that doesn't allow for that. So we just move on to
the next one here.
No, maybe we'll just open the doors here on Clubhouse. We have Jeff that has joined us. We had Colin as well, but we'll get Jeff to come on in. Jeff, did you have a question for Dugan? We'll get Jeff to unmute himself. 3, 2, 1. We'll move to Colin. Do you have any question for Dugan? Colin, please go ahead.
Colin.
Oh, 1 second. Let me just give me a moment here. Say it again. Go ahead.
I've been in and out with my paperwork here, but it sounded like what you were saying was, as an operator, if you have your own deal that you're putting together, you don't need to go worry about getting special licensing. Was that correct?
Dugan, I believe he's asking a question as far as if you're your own operator and you're looking to raise money, you don't need to go and get a license to be able to raise money for your own deal. As long as you use the exemptions that are in place by the SEC, you can raise money as long as you're following those.
That's right. So you get an LOI accepted today on an apartment building here in the United States, and it's your deal and it's your offer. And you know that once you enter into you get your kind of your capital stack, right? Your loan and your equity ironed out, you'll be able to go raise that equity yourself without any special licenses.
I appreciate that. That's actually the exact situation I am. So I appreciate that, Dugan.
Great. Anyone else on Clubhouse? Please raise your hand.
And in the meantime,
Jeff is back here. Yes, go ahead, Jeff.
My Clubhouse crashed momentarily. One of the advantages of real estate is, as you mentioned previously, is depreciation, its effect on your income taxes and the deferment of that. How does it work with regards to having foreign investors? And because I've heard multiple counts where August was speaking about was using LLC, which could take advantage of depreciation, but I've also heard accounts by which American investors can really receive a larger portion of depreciation because the operator does not have to give the depreciation to the foreign investors.
Yeah, so I would tell you that certainly all of my clients, it's a pro rata share. Depreciation typically tracks equity. So if you're a foreign investor and you've invested into an offering, I would tell you, and if I was vetting that offering for you as a passive investor's lawyer, I would tell you that we need to hold the sponsor's feet to the fire. They need to be giving you your pro rata share of depreciation, just like a US based investor. And one of the things that August mentioned that is a brilliant point for investors or that are thinking about investing in the US market, instead of investing through an LLC, create a limited partnership, which is essentially a pass-through entity that prevents this double taxation issue. And the company, most sponsors and operators that have active offerings, at least in the US, will allow any type of entity, provided it's a suitable investment for them, to invest in that offering. So if you're a Canadian investor and you have a US limited partnership that is your entity instead of an LLC, and you're investing in that, you should expect what we call a K1, which is your portion of depreciation as well as income for purposes of being able to offset other passive income. So you should not, in my opinion, this may be just my opinion, blindly accept that just by virtue of the fact that you're investing either from Canada or the UK or anywhere outside the US, that you should not receive your fair share of depreciation in the deal. I think you should, and the offering should say that. It should set forth, or the operating agreement, which is that legally governing document that exists between the sponsors and the passive investors through the life cycle of the asset. It should describe who gets depreciation, and in many respects, they should say everybody, all the members, all the passive investors, according to their pro rata share.
Great. Well, I appreciate
Fantastic. All right. So next,
great question by Tammy.
Yeah.
Excellent question. So I would like to, when can you begin sharing? And the reason I really like this question is because there's just so much different information that's come to me when facing the same issue, as far as when an operator, and you don't have to really be even a apartment syndicator. You can be an individual who's good at finding deals. And now you have certain restrictions when it comes to raising capital or making this offering to your friends and family, business associates, or raising private capital. Is at what point can you present this deal and say, hey, listen, this is a deal I'm looking at, and I'll read Tammy's question.
Yeah.
When can you begin sharing the opportunity to your friends, family, and accredited investors in the case of 506B? So yeah, just to kind of add to that question is, you're an individual who's good at finding deals, right. And now you have this diamond in the rough, as Ava likes to call it. At what point can you present the deal to your potential investors, if it's through private equity or if it's friends and family, before actually there's any exchange of funds? You're just talking about it, just talking about a business idea. At what point can you do this? Is that compliant? And kind of where are the do's and don'ts when it comes to the early stages of presenting the deal to your potential investors?
Yeah, so in the States, on a 506B offering, talking to people that you have a pre-existing substantive relationship with. Remember, these are not strangers to you. These are people that you know. These are people that know you, like you, trust you. These are the most fertile field for somebody that's likely going to invest in your offering. And for you to show them essentially either your business plan or your marketing deck that has your business plan, your underwriting all in there with some pictures about where it's at. There's nothing wrong with being able to show that to people, saying, hey, this is something that I have under contract and we're in the process of pulling together our offering. Is this something that I could potentially send to you when it's ready, when it's complete? That's fine. That's not a violation of what we call the general prohibition on solicitation. So, because remember, we're not sending out cold email blasts to our 3,000 BFFs on Facebook. We are selectively targeting and talking to individuals that are already known to us, that know us, that are open to that. And that's not a violation of the solicitation. So to answer the question is, whenever you feel is the right time for you to discuss with them the general parameters. So the things that I would tell you are, make sure that you're not making any guarantees at any time. Make sure that the investor knows that this is not the offering, that this is these are the general overview or details of something that is being prepared, if that makes sense.
No, for sure. And I mean, this concept of intent seems to be a common topic or common saying in law. But can a operator prior to making a decision of what exemption they're trying to use, does an operator have to be secretive? Do they have to be totally closed down as far as the deal they got? Is there any option that they could possibly say, hey, you know what, my Facebook group, I'm looking at this deal. I'm not making an offer. I'm not telling you to invest with me, but there's this deal I'm looking at. I might end up raising money for it, or I might end up buying it, but there is a deal I'm looking at. Is there a gray area there? Or kind of, you know, and I'm making this very technical, but again, so it depends.
So
We're probably going to start with.
Well, the SEC says no, there's no gray area in that respect. So that hypothetical of you saying, "Hey, I'm looking at this potential opportunity. If I get it, we're going to syndicate the equity needed." I would say, and the SEC would say to you then you're going to be doing a 506C offering. And the reason why they're going to say that to you, potentially, if they're listening, which they do care, and they do listen, and they are watching, the reality is they don't want you to engage in what we call conditioning the market or softening the market. In other words, you posting something that's not just generic details about your company or your investment philosophy or educational content, all of which is permissible. That's fine. But if the intent, like August says, if the intent behind the post or by the sharing of the information is really designed to drive potential investors to you for purposes of a future offering, that's what we call conditioning the market or preconditioning the market. And that's not prohibited that is prohibited, I should say. That is prohibited. You cannot condition the market or precondition the market in that area. So if you're thinking to yourself, hey, I might want to blast this out, that's fine if you decide to blast it out, but just know that you're going to be looking for an exemption that would allow you the ability to advertise, which might limit the market potentially for potential investors for your particular offering. So just be careful with what you're doing and what you're putting out there, and what, like August says, what the intent is behind that particular post or sharing of information.
Great, really appreciate it. We have Benjamin that has joined here on Clubhouse. Benjamin, do you have a question?
Yeah,
for Dugan?
Thank you so much. Yeah, I do have a question. Thank you so much for your time. Kind of building on that, and maybe I just want to double check that our strategy to that question is kosher, which was we usually file 506B, and we're a commercial real estate syndicator. We buy retail, office, and industrial properties around the U.S. So I came up with this idea where we wrote an ebook called 5 Things to Consider in a Real Estate Syndication. And from there, that's our lead magnet to, send them through this drip campaign and educate, inviting them to meet us and connect directly. And then, in theory, and this is a new thing.
Dugan is not nodding his head as you're talking, but keep going.
Okay, yeah. So so I just implemented it. Spent the last few months writing the book, setting up the drip campaign, which just launched this week. And then I'm hoping that it'll start yielding results. We're going to start throwing money at Google and Facebook for now, maybe LinkedIn down the road, so that we can start building that funnel and educating them. And then eventually once, okay, here's the question. So at what point is it kosher to turn and say, okay, well, here's the deal?
Right.
You know what I mean? Do you want to invest?
Yeah. So historically, right? So historically, prior to 2013, we were under this general prohibition against solicitation. And so the question is, how do people grow your investor list? How do you grow your list of potential investors that it's compliant for you to essentially allow them an opportunity to invest in opportunity? And the SEC says it's not a magic time frame. We used to think it was like 30 days, or you had to go out, hypothetically that you had to go out and have a bunch of dinners or go to their house, or there was I didn't know the inside of their bathroom looks like because I've been there. The reality is it's none of those things. The SEC looks at it from a qualitative touch point. And the challenge for you as an operator is, prior to giving anyone, a stranger potential investor, information on a potential offering, the SEC is going to expect that you have some methodology, systematic onboarding process by which you will create a substantive pre-existing relationship with those potential people, so that when that occurs, then you could present them an offering. And the question is, at what point does that occur, right? That was the question. Well, the reality is, when it's fuzzy, right? It's not a 3 dinners, then and then we can do this. No, it's not any of that. It more has to do with you as the sponsor and operator. Do you have sufficient information about the potential investor such that, one, that they would be able to fully assess the risks as well as the merits of the potential investment? 2, are they buying, or would they potentially be investing for their own account, what we say their own account, and not for others? There's no flipping, right? So in the US, these are restricted securities. Everyone that's investing is not, there's a mandatory holding period before any potential resales could happen. So there's no flipping. And 3, in the worst case scenario, imagine the investment fails completely. Is the potential investor able, from your knowledge of them and their expertise, able to withstand the total loss of their investment? If you're able to answer all 3 of those questions, and the information that you have garnered from them, typically it's through like an accredited investor questionnaire or something that will elicit personal details about their investment philosophy. You're also providing them opportunities to ask you any questions about your investment philosophy. It's a give and take. If that process, and I don't want to say it has to be these 5 things or these 10 things, if that process has actually occurred, then they are a potential investor in your Rolodex that you could say, hey, I have an opportunity. It's that I just put under contract and I'm raising equity, and here's my offering. And would you please consider potentially investing with me? That's that process. And so that onboarding thing is not meant to be a rigid, here are the 10 things that you have to do. It's much more qualitative in nature to make sure that everyone that is investing with you on a 506B offering, you really truly know, and they truly know you.
Well, yeah, great. Well said. Great. We appreciate that.
Thanks,
But another very technical, legal way of doing it is have all your webinars in your living room. So when asked by investors, hey, have you been inside their house? What does it look like? Yeah, we've been in there. They have a zebra right on the floor. So, they know it all. So there you go. The problem solved.
Good point, August. Very good point, August.
But Benjamin, joking aside,
Yeah.
I hope that answered your question.
Oh yeah.
And I would love a copy of your ebook, please.
Absolutely.
Yeah, I just put the link in my profile today.
Okay.
We're at hjhinvestments.com/ebook or book, or it's on our website.
Awesome.
And then just a quick follow-up question: if you had any insights or speculation on if there's going to be any SEC regulatory changes coming down the pipeline to any of these topics.
There's a massive one that they're looking at right now. There's massive. Actually, October 6th or 7th of 2020, there was a press release issued by the Securities and Exchange Commission that proposed a new rule, and it was called the conditional exemption for finders rule, which essentially is going to allow a two-tiered type of individual who could potentially capital raise and be compensated for it. Imagine that.
Wow.
To actually be compensated in a fair and compliant way. And so I'm hopeful. I think it's the right move. The SEC did an exhaustive. This is something that they don't take lightly. They move at a very glacial pace. There's been very little massive substantive changes over the last couple of decades, but they recognize that historically the rich just keep getting richer, right? In a lot of these offerings, and the people that big corporations or historical capital raising monsters that were doing their own deals, they didn't have any problem with access to capital. But minorities, women, people of color, or other people that don't necessarily have access to the capital markets or the same mechanisms of potential investment for small business here in the United States, not just in the commercial real estate space, but through the small business space throughout the country, that there needed to be some mechanism by which you could have people that had access to wealth, Rolodexes, but they did not want to be a sponsor, but they wanted to be compensated fairly by making an introduction to that potential investor and to being able to do so in a compliantly legal way. And the SEC has recognized that in its proposed change to add this conditional exemption for finders rule. So stay tuned is what I should say. And hopefully in the next couple months or the coming months, we'll actually have a formalized rule that comes out that will provide greater guidance as well as the requirements that we need to make as operators, as well as people that are gifted, right? Let's say you're gifted like 𝗖𝗽 is in raising capital. So if you're like that and you have that natural gifting, then you will want to potentially look at that avenue when it comes out as a way to connect with other operators.
Great. I appreciate that. Great point.
Stay tuned. Okay.
We're getting on the hour mark here. We usually promise our guests to keep it around an hour. I would like to, and I'm kind of concerned if I open up this question, it might start a completely new discussion, but I'll try it. I'll go ahead and ask the question. It's about, I guess, real estate historically has been a stable asset, a staple investment because of a few main points. One is tangible. You could use it to live in it. It's not an idea or a stock or some kind of a venture capital kind of concept you're investing in. If you can't rent it or economy goes bad, you can actually move into the asset itself. So and the other factor about it is because the process of liquidating a real estate asset is somewhat it's a process you have to go through. There's lawyers involved, escrow, and brokers involved. So the liquidity is not instant the way that the stock market is. But with the new world of technology, you can just see us as a newer, smaller firm. We have such kind of availability for such product where the investor, in our case, our investors receives limited partnership shares. Those are the securities they receive when they invest in our product. Those limited partnership shares, those securities historically have been, you can't trade them. You can't, a very difficult process to even try to sell them back to the general partner. There is no liquidity within those shares like the stock market or other investments. But what's happening now is that liquidity is coming to the world of real estate investing, especially when it comes to syndicated investments. So talk to us about if you have any kind of if you have any view about it, if you heard anything in that space, and yeah, just have a quick conversation about the liquidity of limited partnership shares or
let's
shares.
jump into the future a little bit here.
Yeah, so I'm a big believer in obviously commercial real estate, right? I think it's one of the best tax saving, wealth growing, legacy building things out there for investors. I wish that I had started investing much earlier in my life, and it would have benefited me. It would have benefited my kids and my family and everything. So I think that when you're the lack of liquidity in restricted securities is still there, right? So there's what we call a mandatory holding period that restricts your ability to resell, to either to engage in a sell on the secondary market or to bring in another party. But after if you're a passive investor, look for operators that are open to the ability that after that holding period expires, that they're open to allowing a proposed transfer. Either the company has some sort of redemption rights that you would be able to trigger as a passive investor, or the lockout period, which is often the period of time within which a company restricts your ability to even seek redemption or sell your securities on the secondary market to anybody. That they're open to those things, because you're seeing what you're seeing in the commercial real estate market that you don't see almost in any other asset classification, is this concept of depreciation. And in many respects, the tax benefits associated with investing in commercial real estate last beyond just 1 year, 2 years, 3 years. And so there are additional drivers for potential reinvestment for other investors that are looking at it that might want to buy your interest. And if they're accepted and approved by the general partner of your potential offering, then you've just found yourself a way to get in, receive some amount of depreciation and cash flow during that period, and then also sell. But I like to tell people always, when you're going into an investment, like August said, when you're going into an investment in real estate, prepare for the long haul. Prepare yourself mentally, financially, for the prospect that you may never be able to sell these interests until the exit, whatever that exit looks like, refinance, supplemental loan, or actually the sale of the underlying asset that will give you back your invested capital plus whatever your pro rata share is of the excess distributions that flow from that sale. But you got to prepare yourself mentally that you're in that for the long haul, but understand that who you choose to invest with and what their philosophy is for you as a passive investor will impact whether you even have the ability to sell your interests on the secondary market at some point in the future.
Great. Awesome. And let's close it off here today with the two questions we always ask our guests.
Absolutely. So, Dugan, what is your number one advice, the best advice you would give to a passive investor?
So passive investors understand the track record of the sponsor and actually do some due diligence. So actually either hire somebody to help you vet the PPM, the offering, if you don't understand it and it's thick. These things, I realize they're massive. but actually check on the references of the potential sponsors and operators to make sure that it's a good fit, because this is like a business marriage. And it's a business marriage in which you as the passive investor largely don't have a lot of rights, intentionally so, rightfully so. There's nothing abnormal about that. I don't want you to get weird about it or nervous about it. That's fine, but understand what your rights and responsibilities are in that structure, I would say, is number one for passive investors.
Amazing.
Awesome.
Incredible advice. Now, the second question I have for you is, what is the best advice to active investors or syndicators?
Do it. Do it. Don't be afraid. Paralysis by analysis. I tell people, operators, young operators, newer operators, or even seasoned operators, the idea of procrastination is often the biggest deal killer. And for people that are just getting started to syndication, they think to themselves, I can't do it. I'm not going to be able to raise the money necessary. So obviously, if you're just starting out, set the price point at a particular realistic, right? You're not going to go into your first, your first deal and try to raise $30 million. That's not realistic, but set a realistic goal. Surround yourself with good team members. Ava and August told you this from the very top. This is a team sport. Everybody, it takes a team involved with you to make sure that this goes. So nobody syndicates by themselves. The whole point of syndication is I don't, in and of myself, have the liquidity, net worth, talent, expertise, skill in order to get this asset to the closing table. So if you know that you don't have the net worth and liquidity to do that, and you're using other people's talent, skill, net worth, liquidity to get to the closing table, why wouldn't you also tap into other people's skill sets for potential general partners and strategic relationships in order to make that same assessment? So while you're pooling other people's money, you're also pooling other people's talents on your team. So surround yourself with a great team and just do it, is what I tell most active syndicators, seasoned syndicators, or people that are just saying, I'm just getting started in the business.
That's incredible advice.
Incredible, great advice. And Dugan Kelly, you are a gentleman and a scholar.
Absolutely.
We can't wait to have you back on again. We really appreciate you taking the time and providing wisdom to all our viewers and listeners. I hope you have a great day. Thank you, everyone, for joining us.
Thanks for having me.
Really appreciate you. Thank you so much.
Thank you. I will. Thanks.
Have a great day, everybody. Thanks for being here with us today.